Hey everyone, and welcome to this explainer. I am so glad you're here with us today because we are going to do something a little different. We're going to completely set aside the noise, the hype, and all that confusing financial jargon that gets thrown around on social media. Instead, we're going to investigate the real story, the one that's hidden right in plain sight on your screens every single day. We're looking at the foundational language of price action. Because, look, whenever you open up a market chart, you aren't just looking at random, chaotic movements or squiggly lines. No. You are looking at footprints. These are actual footprints left behind by a constant, daily, absolutely ruthless war between buyers and sellers. And the beautiful thing is, once you learn how to read those footprints, you stop guessing and you start actually understanding what the market is trying to tell you.
Okay, let's dive right into this. Over the next 10 minutes or so, we've got a really clear 6-part roadmap to decode these footprints. We'll start with the anatomy of a candlestick, then move to bodies, where price settles, followed by shadows, zones of rejection. After that, things get really interesting with the smart money trap. Then we'll learn sizing up the shadows, and finally, reading the battlefield.
All right, let's kick things off with part 1, the anatomy of a candlestick. To truly appreciate what we're looking at today, we really have to look back for just a second. It's fascinating because for decades, prior to the 1990s, the Western financial world relied heavily on these simple, honestly somewhat clunky bar charts to track prices. They worked, but they lacked depth. But over in the Far East, traders had already perfected a much more visually intuitive tracking system, candlesticks. It was essentially their secret weapon for understanding momentum. It actually wasn't until the early 1990s that a few pivotal financial books and newspapers brought this Far Eastern method over to the West and popularized it, and the idea spread like wildfire. Today, candlesticks have completely taken over the industry. They are, without a doubt, the absolute ultimate visual tool we have for tracking the modern battlefield of supply and demand. So what exactly is it? At its core, a candlestick is simply a visual representation of price fluctuations over a specific block of time. But more importantly, it beautifully illustrates the active war between buyers, who represent demand, and sellers, who represent supply. Whether you're looking at a microscopic 1-minute chart or zooming way out to a daily chart, each individual candle is a completely self-contained story of a battle. Now, if you see a green candle, it signifies that by the end of that specific time period, the buyers were dominant. They literally won the period. But if you see a red candle, that means the sellers overpowered the buyers and forcefully took control of the price. It's a pure visual snapshot of who is currently winning the war at that exact moment.
Moving right along, let's get into part 2, bodies where price settles. This is where we focus on the thickest part of our clue. Now, what's really interesting about this is the dramatic psychological contrast between long and short candlestick bodies. If you're looking at a long body, you are looking at undeniable conviction from the market. A long body shows us decisiveness, incredibly strong momentum, and what we call an imbalance. In this state of imbalance, one side, either the bulls charging up or the bears dragging it down, is actively dominating the trend with overwhelming force. There's no question who's in charge. But on the flip side, a short body warns us of market hesitation. It indicates a pause, indecision, and a state of balance. It essentially means the buyers and sellers are completely deadlocked in a stubborn tug of war, and neither side is able to gain any significant ground right now. There's a quote that perfectly summarizes this concept, and it goes like this: "The body tells us exactly where the price finally settled after the battle." I really want you to let that sink in because it's such a vital, foundational concept to absorb. Think about it. During any given trading period, the price might jump wildly up and down, right? It's being driven by breaking news, algorithms going crazy, or just sheer panic. But the thick body of the candle blocks out all that temporary midday noise. It represents the final, undeniable resting place of the price action. It is quite literally where the market collectively agreed the value belonged at the exact second that time frame closed. Which brings us seamlessly to part 3, shadows, zones of rejection. Now we're going to look past where the price settled to where it was violently pushed away. A shadow, which you'll also hear called a wick or a pin bar, is that thin line you see extending above or below the thick body of the candle. It represents the extreme highs and extreme lows of that specific trading period. But here is the critical part. A shadow isn't just a simple, boring record of a random high or low. No, it is a fiercely defended zone on the battlefield. It represents an area where the price tried to survive but was forcefully rejected. It tells us that the opposing force stepped in, planted their flag in the ground, and drove the price right back to where it came from. It's evidence of a massive counterattack. And because of that, these shadows can completely change the true story of a candle. Take the upper shadow, for instance. A massive upper wick represents intense selling pressure. Even if the thick body of the candle is bright green, a long upper shadow means the buyers pushed the price sky high but suddenly ran into an absolute brick wall of aggressive sellers. Those sellers then drove the price all the way back down before the period even closed. A lower shadow represents the exact opposite. It shows intense buying demand. It means the price collapsed into a massive panic zone, which triggers a lot of sweaty palms, right? But the buyers saw an incredible discount and aggressively bought it all the way back up. So a massive wick can completely alter the reality of what the candle's color initially seems to be telling you.
Let's pause for a second. Have you ever bought a stock or an asset just because it was rocketing upwards in the middle of the day? You feel that rush of excitement, you finally click buy, only to watch the price instantly crash right after your order goes through?
Yeah, ouch. Which perfectly introduces part 4, the smart money trap. Let's unmask what's really going on behind the scenes there. If you felt that pain we just talked about, believe me, you are not alone. And more importantly, it absolutely was not an accident. What you experienced in that highly painful moment was very likely what we call a liquidity trap. A liquidity trap is a deceptive move engineered by institutional smart money. We're talking about the massive players here, big banks, giant hedge funds, and complex algorithms that trade with millions or even billions of dollars at a single time. And this brilliantly illustrates exactly how an upward trap unfolds over a single trading day. Step 1. Smart money steps in and drives the price rapidly upward. Now, midday, this looks like a massive, beautiful green candle on your screen. Step 2. Retail traders who are staring at their screens midday experience intense FOMO. They're thinking, oh man, this is going to the moon, and they aggressively buy into all that hype. Step 3. Now that all these eager retail buyers are perfectly lined up, smart money finally has the liquidity they desperately need. They dump their massive lot of shares directly onto these new, unsuspecting buyers. Step 4. Because the institutional selling pressure is so incredibly heavy, the price completely collapses by the time the market closes. So what looked like a giant, unstoppable green body midday shrinks all the way down, leaving behind a massive, deceptive upper shadow. And just like that, you realize you bought the absolute peak of the trap. So how do we spot this before it's too late? Let's move to part 5, sizing up the shadows. Here's the exact mathematical formula to solve the mystery. We essentially have an ultimate decoder ring for this problem, and it comes down to simple math. If you're looking at a chart and you see a shadow that is smaller than the candlestick's body, you can usually relax a bit. It typically indicates normal, healthy profit taking. It's just expected market noise. Maybe day traders casually closing out their positions, and that shadow is actually highly likely to be filled in later. But if you look at a candle and the shadow is 2 to 3 times larger than the body itself, stop right there. You have a massive red flag. That dramatic mathematical ratio is the exact signature of a liquidity trap. It fundamentally proves to you that extreme emotion was injected into the market and smart money manipulation is highly active. So the absolutely crucial point here is how you adapt your behavior to survive these shadows. Let's summarize these strict survival rules. First, always remember that long shadows are a signature of intense, often manipulated emotions. Second, short shadows simply lack the intense emotional requirement needed for a trap to function. Third, you must always compare the shadow directly to its own specific body to calculate that 2 to 3 times ratio rule we just talked about. Fourth, and perhaps most importantly, honestly, if you take nothing else away from this, avoid making midday emotional trades. The chart is actively lying to you in the middle of the day. You literally must wait for the period to officially close so you can see the true final footprint that the market leaves behind. All right, bringing it all together, we arrive at our final section. Part 6, reading the battlefield. A good detective has to combine all these clues to get the full picture. Consider this foundational truth for a second. Combining strong trending bodies with moments of consolidation is the absolute key to holding a winning position without panicking. You see, a healthy, unstoppable trend isn't just going to be an infinite staircase of massive green candles shooting into space. That's not how markets work. A genuinely healthy trend will have strong, long-bodied candles that show clear conviction, naturally followed by short-bodied consolidation candles. That's just the market catching its breath and establishing a new floor before the next move. It is not an immediate reason to flee. Let's actually walk through the proper, calm procedure for reading this flow and safely managing your trades. Step 1. You identify a series of strong, long-bodied trending candles. Great. You are in a solid position. Step 2. You note when those large candles start to shrink into short-bodied candles. The market is just entering a state of balance. Step 3. Here is where most people fail. Do not exit immediately out of fear just because the momentum paused for a second. The natural human instinct is to lock in profits the very second the chart stops going straight up, right? But exiting at the first sign of consolidation often means you are leaving a massive amount of profit on the table. Step 4. You simply wait for a definitive opposing candle. For instance, if you're riding a beautiful green trend, you wait for a strong, long red body to actually prove to you that the bulls have been totally cleared out and the bears have firmly taken over. Let the chart truly prove the reversal before you hit that sell button.
And that brings us to the end of our analysis. I want to leave you with this final provocative thought. The next time you pull up a chart on your screen, will you just see a random assortment of red and green lines aimlessly dancing around? Or will you look closer? Will you meticulously measure the bodies, appropriately size up the shadows, and actually read the distinct footprints of the trap before it snaps shut on you? Thank you so much for joining me on this explainer. Keep your focus sharp, actively stay out of that midday noise, and I will see you next time as we uncover more fascinating truths hidden right in plain sight.